Good morning, everyone. Welcome to this update for global markets for the 29th of May. During the week, we had a little bit of weakness at the start, and then it all finished quite strongly around the world. And the correction in gold, I guess, was probably the major talking story of the week. I see this as a very healthy step, and it just sets up a terrific opportunity. So I'm not perturbed at all about what's happening in the precious metal space. So we'll get to that in due course. Just before I go on, I just want to show this little cartoon that I think is extremely appropriate and really illustrates where we're at. It's showing central bankers trying to put out a fire with a petrol hose. And I think that's just such a great analogy for where we're at the moment. They're trying to solve a massive debt problem that they created with even more debt. And, you know, if that's not the height of stupidity, I'm not sure what is. So look, it's hard to know their agenda. I guess it's heavily political. They're not going to allow a disaster on their watch, but eventually that disaster is going to be imposed. Last week, I went through a bigger picture consideration of how I see things unfolding. I'm not trying to be doom and gloom here because it's not my style. I'm normally very positive in the way that I look at things, but sadly, I think a significant collapse of our financial system is inevitable. Now, whether that takes 10 years or longer, I have no idea, but I just think that it is inevitable, that we're past the point of no return, and that you need to be aware of that so that you can plan your future finances and wealth building around that. There'll certainly be opportunities, so it's not a disaster. I think in any situation there are always great opportunities, but you need to be prepared for them. So let's get on and have a look at what happened last week. Or actually, before I do that, I'll just mention that last week I went through a very detailed appraisal of how I see things unfolding at a big picture level. And if you didn't see last week's video, I would certainly encourage you to go back and look at that. And I intend every probably 4 or 6 weeks just to do a really big picture rundown as a perspective sharpener for not only myself, but for everybody else. So I'll just show the one slide though that did wrap that section up, and it's just on what actions we should take. So very quickly, I would really encourage you to remain open-minded to contrarian thinking. In other words, if the masses are thinking one way, and that might be that gold is going to $600 an ounce, or oil's going to $10 a barrel, or stocks are going to fall by 50%, whatever the conventional thinking is, be open-minded to the fact that thinking is probably wrong and we're at a reversal point. And then look for the signs. Now, I'm not saying that you take contrarian positions for the sake of it, or you take it trying to anticipate a bottom in the market. That's absolutely foolhardy, and that will probably result in you losing a lot of money. But all I'm saying to you is be open to the possibility, and if the signs are there, be prepared to acknowledge them and accept them. So I would question every bit of conventional wisdom that gets sprouted by the media, by academia, because most of it is proven to be wrong, and those bits that aren't necessarily wrong are generally very poor in terms of their timing. Following the strongest trends, even if it seems illogical, is absolutely the way to go. Markets are being driven these days by technical chart patterns far, far more than they used to be. And that's because the world's been taken over by computer algorithmic trading programs. It's as simple as that. They've got to be based on something, so they're based on chart patterns. They're not based on fundamentals. Now, I don't mean to intimate that fundamentals are no longer relevant. They are, of course, but in the longer term. But within the time frame that most of us are operating, chart patterns are far, far more important than they used to be. The next thing is to wait for and be prepared to act on new trends. This is the most straightforward way to generate strong, low-risk returns. I'm getting a lot of emails from both members and non-members at the moment, really cracking their neck to raise their exposure to precious metal stocks. But look, patience is important. So part of the game is a waiting game as well as an acting game. But make no mistake about it, if you can get into unfolding, long-term, multi-year, strong trends in the early stages, and I'm talking in the first 6 months, then that is the most straightforward way. It's not necessarily an easy way because of the volatility, but it's certainly the most straightforward way. And finally, precious metals stocks should be a key part of everyone's activity, in my opinion. Now, some people, again, conventional thinking is gold stocks are speculative, it's a casino, and it's just a good way to lose money. And for a lot of gold stocks, that is a true statement. However, there are equally a small number of outstanding stocks, or let's call them gold businesses. We should think of them as great businesses because any business that has zero debt or extremely low debt has profit margins of, in the case of some Australian stocks, profit margins in excess of 70% and are generating huge amounts of cash flow. That's just a great business by any metric. So I would again encourage you to be open-minded about the place that gold stocks can hold within your portfolio. Let's look at the American market now. The S&P was higher by 48 points on the week, 2.3%, so quite a good gain. It's tucked up under the 2100 point level, poised to break through that level again. And as you'll see, there's just no denying that the chart pattern on the S&P is really quite positive. And this is all at a time when bullish sentiment is at decade lows. Since 2009, people have been waiting for the next crash. This has been the most hated bull market in history. And that really goes to my point about being open-minded to contrarian thinking. Those that have stayed out of the market for much of that period, and there are a lot of people who have, then they've missed one of the best bull markets that we've ever seen. And it was all because they thought like everybody else thought. And people are obviously still thinking in that mode. Now, the possibility of a June rate hike is certainly there. The Fed is kind of rolling that card out every now and again. But interestingly, equities are just kind of shrugging it off at the moment. It's like, the odds of a June rate hike have increased significantly from around about 5% a month or so ago to now it's around about 30%. And yet equities are sort of yawning and not really caring too much. So that's another interesting development as well. The medium-term direction in the S&P index, to my mind, unquestionably is to the upside, as you'll see when we look at the chart. All 9 sectors are trending upwards, and that's creating opportunities because, again, we've had some sectors that have been out of favour, financials, some parts of healthcare, and I think people have shut off to them, and there are opportunities unfolding now in those sectors. I'll just go to the S&P chart before I move on with that, and I'll come back to how I sort of see things from a logical and contrarian point of view. This is the S&P index on a monthly chart, and we had certainly some destabilization. It started in August of last year, and we got some great volatility, but you'll notice on a monthly basis, when we got into this year, January, February, and March, whilst they had considerable volatility contained within those months, they all closed pretty much on their highs. So they all finished very well. And since then, we've moved a little bit higher, and we're just tucked up under the all-time highs. It's equally possible that this is a pause. So we had this massive run, and we've now had a pause in the market, and that pause could go on for possibly another 12 months yet. So we could remain within this sideways band for a lot longer. However, it's possible that after that we then move higher, and I'll address some of the fundamental reasons why that could logically be the case. So that's the S&P on a monthly basis. If we zone in a little closer on a daily basis, you can see, you look at that chart, since the double bottom we formed here in January and February of this year, this is really positive action. We went up at a very, very rapid rate. We then had another consolidation within a shorter time period, and you can see how the week finished. Very, very strong, and that is at a time when talk about the Fed raising interest rates has become its strongest. So there's no denying the price action in the American market. Part of what I see at the moment is a bit of a Goldilocks outcome as far as the market sees it. It's not necessarily my view, but I think this is how the market is seeing it. That it's not too bad, it's not too good. It's just about right. There's no reason for the Fed to do anything dramatic. There's no inflation really that's a concern. There's no wage growth that's a concern. Global growth is anemic, but it's not negative. So there's not really a reason for central banks to move away from what they've done, even though I think what they've done is completely wrong. There's no reason for them to change it. And the reason that markets are responding so positively to that is that we've got these massive bond buying programs and negative interest rate policy in Europe and Japan. And so what that's doing is it's causing people to buy, particularly in Japan and Europe, to buy more US Treasuries or US 10-year bonds than would otherwise be the case. And of course, if they're buying bonds, then that's pushing the prices up and the yield down. On top of that, US Treasuries, the 10-year bond, is also considered a bit of a safe haven asset at a time when people are looking for safe havens. So that attraction increases as well. So overall, US bond yields are lower than they otherwise would be, and hence fund managers are looking at that and saying, well, the return is so bad in bonds that I may as well be in equities. And we've got a pretty rare situation at the moment where the dividend yield on the S&P index is actually higher than the 10-year bond, and that doesn't happen very often. And so that really explains why stock prices continue to rise when there's so many negatives out there. It's just the best place, well, perceived as the best place to be. It's not a value position, but it's better than the other alternatives that are out there. So it's perhaps the least worst of the investment alternatives. It's hardly a good rationale for doing it, but it just is. Now, turning to Aussie stocks, the Aussie dollar was lower again to 71.8, largely about the US dollar holding. And last week, I said that there was critical support at this 92 cent level on the US dollar index. That support held and, in fact, reversed very strongly. And so that pulled the Aussie dollar down. And I really can't see any reason why those trends won't continue. US dollar up, Aussie dollar continuing to head down. Now the ASX 200 put on another 54 points and is tucked right up against a key level that everybody's watching at the moment, which is 5,400 points on the index, but really struggling to break through there. The Australian market, and has been for a long time, is very much a stock pickers market. I wouldn't even go so far as to say that you can work on various sectors. In America, the sector strength is one that can be followed. You can buy sector ETFs, but in Australia, I wouldn't even consider operating on a sector basis. It's just a stock by stock scenario, in my opinion. So let's look at the Australian market. Well, first of all, we'll look at the US dollar. So let's pan back and take a big picture look. So there's that key 92 cent level, really, really critical. If we go way back, you can see just how important this 92 cent level was, going all the way back to September 1998. You can see all those key points that level created, and yet again that support level has held, and you can see we ended up with quite a strong run over the last few weeks. So if we then go to the Aussie dollar, that's now pulled our dollar back down again. We are still in an overall downtrending channel. And one thing that I've learned over 30 years in the market is that you don't fight the trend. And despite what you might think, and there's the Aussie dollar, clearly you have to say that the path of least resistance is to the downside. Now it might bounce around a while in this low 70-cent area, but the trend unquestionably is to the downside. The ASX 200, just for the record, is still in this consolidation period, struggling to get through this 5400 level, which is just here. We had a little look over it during the week, but finished just backed off a little bit. And yeah, the Australian market is just really a stock pickers market. I wouldn't be playing the indexes at all. Turning now to the big story, precious metals. And at a big picture view, I just want to reiterate again, because there's quite a lot of negative sentiment still out there. There's no little to no reference in the financial pages about gold. There is still a lot of skepticism out there. There's a lot of brokers with sell recommendations on gold stocks, and that's all the way it always is. Again, it goes back to the point I made right at the start. You've got to be a contrarian thinker, because at the turning points from a bear market to a bull market, 90% of people are going to remain negative, and that includes the financial press and analysts. So that's just one of the parts of the game that you've got to play. You've got to learn to switch off from that conventional thinking. So I believe we're at the start of a very, very significant multi-year advance. And history shows when gold and gold stocks embark on a bull market, they run for many years, and the gains are very, very substantial. So I'm not projecting anything here that doesn't happen virtually every time. So history would show that if you look at the average gains, if you looked at GDX or HUI, which are two of the main gold stock indices in America. So these aren't the performance of the better stocks. This is just the index average. Gains of 400% plus. So what happens? It just happens virtually every time in the cycle. And as I mentioned earlier, gold businesses are in great shape. They've deleveraged. They've got their debt down. They've got their costs down, and they're making very, very good profits. So that's from a fundamental point of view. From a technical point of view, what we're seeing at the moment is a welcome retracement. If the market had just kept advancing, then the ultimate retracement would have been even bigger and scarier. So this is a welcome retracement. This is May, June is the low point in the year for gold prices and gold stocks. But this retracement just remains very orderly. I'm not seeing any dramatic moves at all. So let's take a look at some charts. So we'll start first of all with, this is the weekly chart for gold, and somewhere around about the 1200 mark or just below, I think is a pretty reasonable pullback point. We get a better view of that if we look at the daily. So we've got a couple of levels here. We've got a support level here at about 1195. We've got the Fibonacci retracement level that actually needs to move up just a little. Sorry, let me get this right. Okay, so we've got retracement levels at around 1206, which is pretty close at the moment. We've got some support at around 1195, and then we've got another the 50% Fibonacci retracement level at about 1175. So I think in this area here, between about 1175 and 1205 is where we're most likely to see a bottom in gold prices. Now, as we know, gold stocks have been massively outperforming, and they've also started to outperform a little bit to the downside, but again, that's normal and a good thing. Just before I go there, let's just look at the price of silver. So silver has held up quite well, and also is looking quite positive during a decline phase. Let's look at the GDX index. So the GDX index, I'm looking at either the 2077 area would be the first Fibonacci retracement level, and given that the price action has been so mild, the retracement, I think that it's more than likely that that's as far as it'll go. So I think we're probably only looking at maybe another 10% to the downside. That would also correspond to a retest of this downtrending channel that we've been looking at now for some time. So that would be pretty normal as well. So those two levels come together, and we've also got a key support here also in that sort of general vicinity as well. So again, I think around about another 7 to 10% on GDX would probably see the correction out and set up for a major advance. Now, I want to make a really key point here. If the bull market in gold stocks goes where I think it goes, and we're talking 400% plus gains over the next few years, I can tell you that there will be retracements of between 25 and 50% in individual stocks along the way. That's almost a given, and most people can't deal with that sort of level of volatility. So whilst this all looks terrific, it's not necessarily as simple as just buying at a point and just sitting on it for a few years. There's a very, very small minority of people that can do that, but most people will be shaken out. Their conviction to what's going on will not be able to withstand the volatility. So whilst I present this as a very exciting opportunity, it's one that does require a pretty strong stomach. And if you've not been in the market for a long time and you've not worked through this sort of volatility, then it's one that most people need some assistance with. Turning to other commodities, copper was higher, $2.14. Crude went up a little bit again, up to $49.33 after going above $50. I will say that the global inventories are still very high for crude oil. There's no question about that. We've got tankers moored all over the world full of oil. So there's no question it's still high, but those inventories are starting to come down in the last month or so. So I suspect that we've probably seen the lows in oil. The lows down in the mid-30s, I think, are probably it. But it may well be that we see oil just bouncing around in this $35 to $50 area for some time. There's the chart for spot copper, has been edging up over the last couple of weeks. So just to wrap it up, overall, the general trends in the market are pointing higher. When you look at the S&P index, you can't deny that, no matter what you think about what should be happening. They are looking positive. I think it's likely that we could get a continuation of this sideways market. But if we are going to get a breakout, then you've got to say the breakout is going to be to the upside, far more likely than to the downside. Precious metals, by far the strongest sector out there. And I just see it as a truly outstanding short and long-term entry opportunities unfolding. I think there's a once in a decade, I won't say once in a lifetime, but for some people it will be a once in a decade opportunity to really build some substantial wealth. And I really hope that you don't miss out on it. There's my contact details for non-members, anyone who wants to contact me and chat about how I might be able to assist you to get access to some of that terrific upside that I think is coming. And I'll talk to you next week. Cheers.